Hey everyone, welcome back to Corporate Decoder, the place to be when we want to peek behind the curtain of company reports and see what those Wall Street wizards are really up to for FRP Holdings Incorporated. Their quarterly filing for the 30th of September 2025 is packed with some interesting numbers that tell a story. So let's dive right into what FRP Holdings Incorporated is showing us. This is their snapshot of what they own and what they owe as of the 30th of September 2025 and the 31st of December 2024. It is a lot of information, but the key thing is to see where their assets stand and how their debts are looking. Their total assets as of the 30th of September 2025 are $731,260,000, which is a slight increase from $728,485,000 at the end of 2024. On the flip side, their total liabilities are $269,064,000 for the 30th of September 2025, up from $259,372,000 at the end of last year. So they are holding a bit more debt, but their assets have grown too. Now let's talk about how much money they are actually making for the 3 months ending the 30th of September 2025. Their net income attributable to the company was $662,000. That is a pretty significant drop from the $1,361,000 they made in the same period last year. Looking at the 9 months ending the 30th of September 2025, their net income attributable to the company was $2,950,000, down from $4,706,000 for the same period in 2024. These numbers are showing a clear decrease in profitability. The company points to a few reasons for this dip. For the third quarter, operating profit took a big hit, down over 55%. They explain that a substantial part of this is due to expenses related to something called the Altman Logistics Platform acquisition. It looks like there were $1.3 million in acquisition expenses alone for that quarter, which definitely impacts the bottom line. Let us break down where that revenue is coming from. FRP Holdings Incorporated has 4 main business areas or segments. The multifamily segment, which includes apartment buildings and retail spaces, brought in $5,556,000 in revenue for the 3 months ending the 30th of September 2025. This is a slight decrease from $5,682,000 in the same period last year. They mentioned that most of this decrease is due to lower net operating income at one of their properties called the Marin, where they saw higher uncollectible revenue and increased operating costs and property taxes. Next up is the industrial and commercial segment, which involves leasing and managing industrial and commercial properties like warehouses. For the third quarter, this segment brought in $1,229,000. This is down from $1,455,000 in the same quarter last year. The report attributes this drop to vacancies, including an eviction of one tenant and lease expirations. They also had higher depreciation costs because a new warehouse project called Chelsea was completed. Then we have the mining royalty land segment. This is where they lease land for mining. For the third quarter, revenues here were $3,689,000, a nice increase from $3,199,000 last year. However, when we look at the net operating income, it decreased by about 26% to $3,756,000 from $5,103,000. This sounds strange, right? More revenue but less net income. The report explains that last year's third quarter included a one-time catch-up payment of $1.9 million for minimum royalties. This payment was spread out over the lease. So this year's numbers look lower in comparison, even with higher actual royalty tons. Finally, there is the development segment. This segment works on acquiring land, getting it ready for building, and then either constructing properties to own or selling the land. For the third quarter, revenues were $301,000, a small increase from $297,000 last year. However, the operating profit before general and administrative expenses took a nose, dived from $25,000 to a loss of $1,189,000. This is mainly because they incurred construction and development costs. When we look at their pro rata net operating income, which is a way to measure income from their various ventures, it decreased to $9,523,000 this quarter, compared to $11,272,000 last year. Again, a big chunk of that difference is that one-time mining royalty payment from last year. Excluding that, their pro rata NOI actually went up slightly. Looking at the longer 9-month picture, the story is similar. Total revenues are up a bit, but net income attributable to the company is down significantly. For the first 9 months of 2025, it was $2,950,000, a pretty big drop from $4,706,000 in 2024. The company points to about $2 million in expenses related to that Altman Logistics acquisition impacting these 9. month results. Even though their overall net income is down, it is interesting to see how their joint ventures are performing. Their pro rata net operating income from unconsolidated joint ventures shows that for the 9 months ending the 30th of September 2025, it was $9,136,000 for the multifamily segment. This is a notable increase from $8,698,000 in the same period last year, showing that some parts of their business are growing. Now, let us talk about what happened immediately after the end of September 2025. On the 21st of October 2025, FRP Holdings Incorporated announced they acquired the business operations and development pipeline of Altman Logistics Properties Incorporated. This is a pretty big deal because Altman Logistics was actually their partner on some of their first industrial joint ventures. This acquisition cost them $33.5 million and adds new development projects in key markets like Florida and New Jersey. They even list out the specific projects. For example, they acquired a 10% stake in a 199,476 square foot warehouse in Delray Beach, Florida. This move signifies a push to expand their reach and scale up their business. So, putting all this together, FRP Holdings Incorporated is navigating a period of transition. Their core mining royalty lands business is performing well in terms of revenue, but the big story is their expansion into industrial and commercial real estate development. The recent acquisition of Altman Logistics shows a clear strategic move to grow and diversify. However, these expansion efforts come with significant costs as seen in the dip in net income this quarter. The company is also dealing with the usual real estate challenges like rising operating costs and managing tenant relationships. From a Warren Buffett perspective, you want to see sustainable earnings growth and a solid business model. While the mining royalties provide a steady stream of income, the future growth is clearly tied to their development projects. The company's strategy to convert non-income producing lands into income-producing assets is sound, but it requires substantial capital and execution. The Altman acquisition, while costly upfront, could be a game changer if they can successfully integrate it and leverage it for future growth. The key will be managing the development pipeline effectively and filling those new spaces with paying tenants. That is our deep dive into FRP Holdings Incorporated's latest report. What are your thoughts on their expansion strategy and the impact of the Altman acquisition? Let me know in the comments below. If you found this breakdown useful, please hit that like button and subscribe for more corporate insights. And be sure to join our community over on Discord. The link is in the description. Thanks for watching, and we'll see you in the next one.